biggest yield curve inversion in 30 years. We're in the midst of it right now, and it looked like if you were checking out interest rates about a month or two ago, you would have thought that this yield curve inversion is finally going away. We've been inverted for over a year now in the U.S. Treasury yield curve. But right now, as we speak, the inversion is getting actually right back to those extremes. And I want to show you what that looks like and then show you what it could mean for the market moving forward. And then after that, show you what you can do to maybe remedy a further inversion or trade on the inversion coming back to normal. But first, let's show you what we're dealing with. Here is a normal yield curve. At the start of 2021, this is where we were at. The shorter duration, 1 month, 6 month, and 2 years, essentially zero interest rates down there, a rounding error off of zero, if you will. And then as you go out further in time, higher interest rates for every year or a couple of years that you add on. That's traditional, that's normal. As you add duration or time, you're going to see higher interest rates, normal yield curve. Interest rates were low, but the curve itself was normal. Everything under 2% going all the way out to 10 years, only around 1%, 30 years around 2%. Everything low, but no yield curve inversion and a normal curve. Now, we're going to take a look at the same 6 points along the yield curve here and get ready for what an inversion looks like. It's going to look very, very different. As we go to now, you can see that it's essentially the opposite, and a couple of things are going on here. Not only is the 1 month and 6 month Treasury bill interest rate much higher than the 5 year, 10 year, 30 year Treasury note and bond, but everything is well over 3% across the curve. So interest rates much higher today than they were 2 years ago. And we have this inversion, and here it gets at the crux of normal curve versus inversion, which is shorter duration. Essentially, if I were to lend my money to the U.S. Treasury for 6 months, they would pay me an annual interest rate of 5.5% versus giving them money that they don't have to pay back for 10 years, and they're only going to give me an annual interest rate of 3.7%. And you see that normal relationship of more time equaling more yield or more interest rate breaking down, shorter time, more interest rate. And this happens for a number of things. The most recent version of this is inflation dramatically heightening since 2021 to it peaked last year, the middle part of last year, and now inflation's still high, but moving lower. And when inflation is high, the central bank will usually hike interest rates. They hike short-term interest rates. So the short-term part of this curve, 1 month, 6 month, and 2 years, those interest rates run up really high, and interest rates in the 5, 10, 30-year range, they move higher as well, but not by as dramatic an extent. And so we have an inversion mostly based in the inflation that we've seen and the central bank hiking interest rates. But you can search all of that. We've done segments on that in the past. It's interesting, but I want to get to more tradable takeaways here as opposed to a conversation on inflation and all of that. What does this mean for the yield curve moving forward? What could happen to interest rates in the near future? How long does this tend to occur for? What can it mean for the stock market? And what can you all do out there to either trade on this yield curve inversion getting worse or normalizing at some point? Well, first, let's rope in some historical context to let you know that this is a pretty rare occurrence. As you can see here, in the last 30 years of trading, this has happened about 3 times. So an average of about once a decade. And it actually is pretty clean here, whereby you had an inversion in the 90s, the early 90s there. You had another inversion in the early aughts there. And then you had another inversion at the tail end of the aughts before we get to 2010. And so about one inversion per decade and tending to occur for anywhere from a month or two, a couple of months. You see there in the 90s, we were not there long, to a year or two, but not much longer than 2 years. I don't think that, at least in this data set that we're working with, about 35 years of data, we have a yield curve inversion for longer than 2 years. Fast forward to now, and we've been inverted for coming up on 2 years. And so, of course, history doesn't dictate what happens in the future. Historically speaking, though, these don't tend to last long. They tend to happen just once in a long while. And when they have happened, you'll note that right there in 1991 range, 1990, 1991, in 2000, 2001 range, and then in 2006, 2007 range, these inversions are occurring right before the stock market is falling and short-term interest rates are falling closer to 0% as well. What's going to happen this time? Of course, you can't necessarily. A lot of people will say, "Oh, well, the stock market has to fall now because this has happened." This is the definition of a small sample size. It doesn't get much smaller than 3 here, and some people won't even kick in that third. They'll just say, "Well, it happened during the dot-com bubble and the financial crisis, and so we have to see a stock market crash coming." Of course, that's not the case. The stock market was lower by, depending on where you look, 15 to 25% last year. Is that a little bit of the normalization we'd see in the stock market to see some normalization in the yield curve? We will see, but the inevitability that does seem to be there is the fact that the yield curve doesn't stay inverted for very long. And I mean, the normal yield curve is so-called normal because that's where we normally are on average. And you can see here, I mean, probably 95% of the data in this range, in this set of 30 to 35 years, is interest rates being not inverted, being normal. And of course, we're just looking at the spread here between the 2-year and 10-year yield. And so when that spread is negative, that means that the 2-year yield is higher. And so the majority of this data is in that normal yield curve environment. But looking at the fact that historically, when we've had these inversions, we've come out of them, usually, I don't want to say because, but it is, I don't think any coincidence that we saw some stock market turbulence around these times, and we saw short-term interest rates collapse down closer to 0%. And if you were to understand that context and then think about today, you might say, oh, well, okay, that makes sense, Frank. I mean, we had this inflation. The Fed hiked interest rates really high. Short-term interest rates moved really high. The yield curve got inverted. The stock market fell a little bit because of interest rates being high and a couple of other things, obviously. And now that the stock market has fallen a little bit and there's some general unease, the central bank is, I mean, you look at the futures market and they project that the central bank might cut interest rates as soon as by the end of this year or next year. And that would stand to bring this inversion out of inversion, or the yield curve, sorry, out of inverted territory, this spread and everything out of negative territory. And does that require a stock market crash? We'll see. I again wouldn't say that it requires it or guarantees it, but in the last 3 examples we did see it. But maybe we already saw enough downside in the stock market to get those interest rates in the short term moving lower and the yield curve uninverted. Enough of if then and projections and this could happen and everything else. Let's take a look at if that yield curve does normalize, which it historically has, what you might want to be prepared for, what you can do. Well, first of all, I mean, the most direct thing is Treasury interest rates are higher than they've been in years and years and years. And that's to say for the short term, the medium term, and the long term. And if you think that the yield curve is going to normalize, and short-term rates are going to come down, or long-term rates are maybe going to move a little bit higher, or maybe both will kind of move one in one direction, the other in the other, you might want to buy some treasuries, given that prices are historically low for the last number of years, especially in that 2-year, showing remember the short-term interest rates being 4 to 4.5 to 5, above 5%. Those are the highest interest rates that we've had in years and years and years. And so it might make sense to buy some treasuries, given those historically low prices and the high interest rates that you would get from loaning out money to the U.S. Treasury. And also, if the stock market does fall, the bond market or the treasury market tends to be seen as a flight to quality, and people might buy up that market as well. So you could lock in interest rates at relatively high levels, and if the stock market does fall, the prices that you paid would likely move higher, and you could either continue to get that high interest rate for years and years and years, or sell back your treasury bill or note or bond at a higher price if that stock market falls. Also, something to keep in mind is you can diversify that treasury duration as well. You don't have to necessarily, you look at the regional bank crisis and how a lot of regional banks got in trouble for locking themselves into 10-year, 5-year, 10-year, 30-year, longer-term relationships with the Treasury and getting only 1.5–2%, and now their books, they're having to give higher interest rates at short-term durations, and they're locked into getting lower interest rates at medium and long-term durations. You don't have to necessarily have something like that. You don't have to lock yourself into, oh, do I, buy a 6-month bill, get 5.5%, but when 6 months comes up and I go to roll it to the next 6 months, if that interest rate is now collapsed to 1 or 2%, then I should have maybe bought the 10-year that was at the time at 3.5% and is now down to 2.5%. I can't get, a high interest rate anywhere on the curve. You can, instead of doing 100% in one place, you could do some 6 months, some 2 years, some 10 years. It doesn't have to be 100% in one duration. Also, you can look at hedging your stock investment if you are worried about the potential fall here. You can sell calls against long stock investment and or buy puts to protect against that stock downside. And then finally, looking at the .com bubble in the early 2000s, obviously that being mostly specific to technology companies, but affecting the overall stock market. The financial crisis in 07, 08, they're mostly, more financial oriented companies, but affecting the stock market at large. You can diversify that stock investment as well. If you think that a crash is coming due to this sector or that sector, just try to rope in as many sectors as possible so you're not vulnerable to that crash. And so there you have it. The biggest inversion that we've seen in 30 years, we're in the midst of it, and we're moving closer and closer. We're now about 70 to 80 basis points inverted. The low for the last 30 years has been 100 basis points. We're right there. But we don't tend to be here so often. We'll see if this inversion normalizes, and there's plenty of things you can do in the meantime.